Hi guys, here we are, Chapter 7, Finance and Accounting, and we're just going to get to it. As I said, a lot of these things are things we've talked about in other classes. We're going to go a little bit more in depth though, and getting financing for your business in this chapter though. So you have to find and fund the firm. You have to fund the firm and get it to the level that you want it to be at. You have to set up an accounting system, and you need to know how information is going to flow. So that's basically what we're going to talk about. So funding starts with the founder or their personal resources. So, money you've saved up or money that you have from a sale of something else or whatever it may be. It's really important that the founder puts some sort of money into the business because it shows for the banks and other people that you are serious with the business and that you're not just playing with other people's money. But you are probably going to need other types of funding. So we're going to talk about those. One is equity investment. Essentially, equity investment is someone gives you money and they exchange for percentage ownership of the business. And then crowdfunding is funds received by businesses by soliciting a large number of small investors, usually via the internet. That's sort of a new thing. Okay, and then non-equity, those are equity options. Then there's non-equity funding, which are loans from banks, credit cards, leasing companies, suppliers, that kind of thing. And then grants, you might get money from grants, winning from business plan competitions. We have the business plan competition in Buffalo 43 North. People get money from that. Okay, so debt is basically any type of non-equity funding tied to the business. So, and it's any form of capital infusion that has to be paid back with interest. Okay, so debt is you got to pay the people back. Again, we talked about it before. Loans from banks, credit cards, credit suppliers, supplier credit, that kind of thing. Okay, so loans, again, and contract. I'm sure you're all familiar with this. Loans are some sort of contractual agreement where the firm receives some amount of money that has to be repaid. So asset-based lending, that's a loan provided for the purchase of necessary asset for the business, a car, a piece of property, equipment, that kind of things. And again, you have to pay that back. Then there's also credit cards that this is another source of debt. So loans, credit cards, which not too dissimilar to having a line of credit from the bank. You can, a business credit card, you can buy it and you don't have to pay it back immediately. You do pay interest on it. And then supplier credit is something that someone might say you can have 30, 60, 90 days to pay something back. Back to the restaurant example, you buy X pounds of flour and maybe you have 60 days to pay it. That's a form of supplier credit, and that's based on a positive relationship you've had with them in the past. Grants, again, can come from the government, or they can come from foundations, or as I mentioned before, locally we have 43 North. And there are all sorts of opportunities for people to receive grant funding for all sorts of different reasons. And something that's worth looking into. You do have some sort of requirements that you'll usually have to fulfill, but it is a possibility, and you don't have to pay it back. You probably have to have some level of performance that you have to, and reporting, but it's there for you. Okay, equity funding is this idea that people give you an amount of money, and in return they're going to get some level of ownership back. Shark Tank. I'm sure you guys have all watched Shark Tank. That's usually equity funding. So you will need to evaluate the value of the company to determine how much the investment how much ownership the investment is going to give them. And it's complicated. You work with attorneys, and you can get them from a variety of places, other firms, venture capitalists, business angels, that kind of thing. So there are corporations that maybe equity investors. Large firms do it. They'll buy into a small company, and let's say you have some great app idea. Maybe Apple will buy into it, for a certain period of time, and then eventually buy you out. And then that's something, again, you should always be aware of who you're getting involved with and what the terms are and how much control you're giving up if you have a corporation as an equity investor. So businesses as equity investor, it's this idea that someone might eventually be interested in buying you. So it is the least expensive means for new ideas or products and methods. So for the purchasing company, and a company will buy you and then eventually put you into the regular fold of the company. They're buying basically what they're buying is your talent and your knowledge and that kind of thing. So there's supplier investment. Again, suppliers could be purchase part of your business, then you become a partnership with them, and there are again pros and cons to that, but it can be a really fruitful relationship. Okay, venture capital or VC. So basically, a venture capital is a fund that's organized to make significant equity investments in high growth new ventures. So you hear these stories about people who do venture capital, and they are going into people's living rooms who have started a business, and the cosmetic company that started in the kitchen and all that kind of thing. But they see a lot of potential for the business. So they have limited partnership. We'll talk about that a little bit later in the semester. Wealthy individuals, insurance companies, other business, retirement funds might buy in. That's where the venture capital funds come from. All right, and then there's business angels that are high net worth people who invest in a business, not as a business but as an individual. And if you do want to have a business angel involved, I would highly suggest getting somebody who has some sort of experience in the business. Again, this is something that when the Shark Tank people are not equity investors, but they certainly talk a lot about their experience in the business. Sorry about that. I dropped my papers. Okay, so the next thing is crowdfunding. Again, it's a new way of getting money. Kickstarter, EquityNet, Indiegogo, that kind of thing. Internet sites have really helped to streamline that process. There are different ways that people might be compensated. You have to, there's a validity issue with that, so you might want to be careful on either end of the crowdfunding, but it is a new and growing opportunity. So there's also asset leasing. So you can, if you want to, instead of buying a truck, you can lease your truck. You can save a little bit of money. And also factoring. So you can sell your accounts receivable. I don't know if I would get too involved in that, but there you go. Okay. So then there's the initial funding. And you want to be able to calculate maximum amount of outside financing needed. And this is just a rule of thumb, multiply the lowest ending cash balance on the cash flow statement by 150%. So that's just a rule of thumb. I highly recommend that if you do these things that, you consult an accountant or someone who has expertise in financing, because you want to make sure your numbers are right before you get in. So here you go. You can take a look. This is just a chart to give you an idea. Calculating maximum outside financing. So what was the value of your firm when you started? What were the different cash flows? You can go through and see that. But always consult a financial professional. Okay, so it's really important too that when you have accounting, again, I said this before, that you don't necessarily need to be an expert in accounting to open a business. You just need to know enough about accounting so that your accountant does not take advantage of you. Bottom line. So here we go. You have different accounts that you'll have. So you'll number the accounts. I think you probably talked about this in accounting. All right, and there's always petty cash. Petty cash are for small incidental purchases that you might not necessarily need to write a check for or a bill for, or have a bill for. So the petty cash register, and you want to make sure that people don't take advantage of the petty cash register. All right, and there's a check register. The check register keeps a list of all of what's going on in your checking account, in your bank account, with deposits and withdrawals. There are lots of programs that help you with that. And then expense accounts, again, daily, weekly listings of expenses. And it's like one of the most important things about accounting is to make sure you keep up with it on not a weekly basis, but a daily basis. and keep track of all the money, because things can get away from you very, very quickly, and that is not good. Okay, and then inventory accounting. Again, all of, whatever if you own a hair salon, all of the hair dye and the shampoo and whatever else you have. If you own a store, the number of, clothing and the jewelry and the shoes and whatever else you're selling. So you want to make sure that you have a good account of your inventory. Okay, accounts payable are what are the things that are your bills, basically. Separate accounts for accounts payable. Invoices should be recorded, just like you record what your expenses are, when you paid it, how much you paid it, what your check number was, what your transfer tracking number was, whatever it was. Important details, super duper duper important, and accurate details, and having someone taking care of your money who you trust. Okay, and then payroll, of course, is how much you're paying people to work for you. Again, very important to keep track of the check number, the number of hours people worked, what their salary, what their pay is, any kind of overtime hours, gross pay, taxes. Taxes, super important. You got to pay your taxes to the government on your payroll. And then any kind of benefit deductions, that kind of thing. Again, there are programs, there are services that take care of these things. But just because there are services that take care of them, it doesn't mean you shouldn't be aware of them and be able to track what your expenses are. And if there's opportunity to pay people more, or if you need to cut back, that kind of thing. Payroll, again, all super important. Paying your people, number one priority. You got to pay your employees. Once a company stops paying their employees or bouncing the checks, that's bad, bad, bad. Which I know seems like such a crazy thing to say, but with small businesses, I hear these stories all the time about small businesses. My payroll, my check bounced. They didn't pay me today. They said they're going to pay me today, but they didn't pay me today. All these kinds of things. That's like a canary in the coal mine, the payroll. Okay, so then you look at the profit and loss statement. Basically, a financial statement that summarizes revenues, costs, and expenses during a specific period of time. It's brief and easily understood, and it really should be prepared monthly. Again, these are all things, all of these financial statements it's like looking back at they're like the pictures. They're like looking back at what pictures did I take this month? What were my pictures in the spring? What were my pictures in the fall? It's a look back as to what's going on in your business financially, and it's super important. Okay, so the profit and loss statement, you take a look at total income, expenses, and then you remember we talked about those account numbers a couple of slides ago. What were the expenses for account 201, expenses for account 160, and then income minus expenses. There you go. That's how much money you made. Okay, and then data flow, also really important. You need to recognize that new businesses are going to differ in the time frames that they need to obtain data based on their industry, based on their experience. However, the more you can keep up on that, the more important, the better information you're going to have. So, and also as time moves on, you're probably going to get more complex. It all depends, but basically you have to manage that flow because it's going to be one of your most important information tools. And accounting and finance records are things that managers use to make decisions. So, and you also want to make sure that you have your original mission statement, that the money that you're spending money on, or the things you're spending money on, are the things that are part of your mission. Or maybe you're realizing that, as I said, the example I gave earlier of the restaurant with the food, the sit down, the bar, and the takeout. Maybe you started as a takeout place, but all of a sudden you're realizing that your restaurant business is really growing. And so maybe you should hold back on the takeout or change the takeout method and increase your restaurant business and maybe increase the bar, keep the takeout, but increase the other things. So it's really important to understand that information because, as I said, they are decision-making tools for you. Okay. Let's just take a look back here. We don't always do a chapter review, but we're going to do one now. So we're going to look at how you're going to fund your business and what kind of funding level is needed, what accounting records should be maintained, and how are they going to be maintained, super important, And also, how are you going to manage the information, all this financial information that you have? Okay, so I know we're going through these kind of quickly, but uh, for many of you, I assume they're a review from your accounting classes. So next, we're going to talk about in Chapter 8. We're going to talk about business and financial analysis, but that's it for now. Okay, thanks.